Hello and welcome to yet another exciting episode of The Investing Edge, where we talk about the science of wealth management, how you too can utilize the best practices of the industry to help manage your money better. Joining me as always is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. And with us also today we have Mr. Arun Narayan, who's been an investor now for over a decade. Gentlemen, thanks very much for joining in. And today, Feroze, the thing that I want to focus on is on NRIs because, if somebody is settled abroad, should they still continue to look at India as an investment opportunity? Is that a good idea? And, what's the advice that you would be giving to your NRI clients?
Yes, Sumaira, I think NRIs definitely should consider India as an investment destination because one, it gives them diversification. Second, if you have plans of coming back to India or if you have expenses in India, if you have relatives in India or dependents in India, it always makes sense to have money in India. Third, India is one of the fastest growing economy. Of course, we've had a short-term blip because of the entire pandemic situation, but it will be back on the growth path with a bang. That's our belief. Fourth is there are immense amount of opportunities of creating more money than what you see in the headline like Nifty and Sensex have a certain return, which has not been very good over the last 10 years. The 10-year return of the large indices has been sub 7%. That itself implies that the next 10 years will be significantly better. The return is not behind us like in the US. So these are the 3-4 reasons why an NRI should seriously consider having at least 30% or 40% of his total balance sheet, which is the surpluses he or she is generating living abroad in India. I think especially given the kind of double-digit return, dollar return possibility, I think NRIs should certainly have 30 to 40% of their money in India.
Okay, Mr. Narayanan, what has been your experience, at least with investments so far? How has the last 10 years been?
Yeah, it's been really good. I've mostly invested in the Indian markets, as Feroze pointed out. Even though I'm an NRI, I'm living in Dubai. It makes a lot of sense for me to invest in India. Even if my long-term plan is not to return back to India, I think if you look at the global situation today, the sort of returns that India can generate over a long period is still a lot higher than what many of the other developed markets around the world can generate. And even if you account for the the US dollar, Indian rupee, long-term depreciation, it still seems to make sense to invest in India. So I've tried a couple of different things, and I've realized that this is the best thing to do, and I've stuck with it.
Feroze, are there any instruments or products which are better suited for NRIs?
To my mind, Sumaira, for NRIs, the best instrument is the mutual fund. 60 to 70% of the total money can be in the mutual fund platform. Given the simplicity of reporting back in the country which they file taxes other than in India. Second is there are several countries where there's a dual taxation treaty with India, which makes mutual funds even more tax efficient. In certain cases, zero tax as well is possible. What stands out for an NRI to my mind, which a resident can't take a benefit of, is the NRE deposit, non-resident external fixed deposit, which becomes tax-free for them. I think that's the only one instrument which is more than what a resident can access. Apart from that, these exotic products which generally get sold to unassuming NRIs should be avoided. I've seen several NRI portfolios being pumped up with unit-linked insurance plans. When they visit to India, they visit a bank branch, and the representative somehow gives them a ULIP plan, which doesn't fit into their need. Just from a commission standpoint, that happens extensively. So an NRI should stick to mutual fund, look at some bonds, look at NRE deposits, also create vehicles which are Indian entities so that he can buy structured products as well.
Mr. Narayanan, like you said that you're investing only in India. How many of these points would you consider? I mean, what all do you look at before you make your decision?
So, as Feroze mentioned, many of those, tax considerations are definitely there, and being in UAE, it is, it is convenient for me to do that in India because I don't have an establishment in India. But in terms of actually, choosing a wealth management firm or choosing, a place to invest or a strategy, I would really rly on, the trust factor that I have with, my wealth manager, with Anand Rathi. So, that's my primary consideration because, there's so many options around the world, and as a normal investor, you wouldn't really know. So, to some extent, I would do my research, but then there's also the trust element, which is really important. So that is something that I've considered. And as far as choosing individual products are concerned, I don't think that's, that's the right way. You probably want to look at a strategy as to, how much you can save and how much you can invest and what your plans and goals are. So it has to be tailored to that, as opposed to choosing individual products. So that is something that I work out with my wealth manager and find out something that is suited for me personally.
Okay, Feroze, coming to you again on products, because I was reading that a lot of the Indian banks offer something called forward contracts to NRIs. Exactly what is it, and is this an advisable investment route?
See, like Sumaira, it's very important to have a strategy in place. Products are going to be several. Of course, the forward is basically a currency forward. Let me come to that in a minute. So point one is be clear that you have a strategy in place. Second, there are about 20 types of products in the wealth management industry, and there's so much complexity in each of them that most clients don't end up understanding the risks which they are taking or the kinds of disadvantages or the demerits each of these product categories might end up having, but the marketing presentations very well camouflage that. So having a strategy just puts things in the right perspective. So point one, have a strategy. Point two, if you have been offered a forward contract, I think that itself is a complex instrument for an NRI to invest. Quite a few people have taken forward contracts on currencies especially and burned their fingers miserably. So it's very important for you to not just look at the optical attractiveness of the offering. A forward contract is very relevant if you wish to repatriate the money back. Quite a few banks can give you a forward contract on the currency which you've remitted. For example, if you have $1 million to invest in India, a person can remit that $1 million to his NRE account, make the investment, and also contract to buy back the dollars, which is $1 million, 3 years hence, if he or she chooses to. The fact that you're locking in the forward rate of dollar to prevent yourself from any degree of currency movement over the next 3 years, that is what is a forward contract generally. If you wish to leave the money for long periods of time in India, like Arun mentioned, the long-term depreciation of the currency is about 3 to 4%. Indian rupee depreciates vis-a-vis dollar to the extent of 3 to 4%. So if you provision for it, and if you're making 13, 14% in Indian rupees, and if you're keeping aside 3 to 4% as a yearly provision, which you will keep aside, then you're still getting a double-digit dollar return. And double-digit dollar return with risk levels half of Nifty is possible only in India. For double-digit returns in dollar terms, of course, the last 2 years an aberration. US markets have done phenomenally well, so people's faith on global market has gone up. Even Indian residents are getting lured towards it, but I think that's at the fag end of it. So don't get into contracts which you don't understand. Forward contracts could also have margin calls, and there's a large implication to each of the decision you take on things which you don't fully understand. So I would not recommend unless you want to take the money back at a specific point in time in the future.
But Feroze, the other thing is that global markets are still quite uncertain, right? So for an NRI investor, is it a good idea, therefore, to sort of have some sort of a hedge? Where does that fit in to their strategy?
Sumaira, I think hedging of a portfolio is relevant depending on how much money have you allocated to equity. Especially at Anand Rathi, we recommend only 39% of the money in naked equity. The other 61 automatically has a protection for the first 20% fall in Nifty. So that leaves me with only 39 rupees invested in naked equity. The rest of it is protected. So do you have to protect the last rupee? The answer is no. If you have 90% invested in naked equity, do you need a hedge? Of course you need a hedge. If you have 90%, that means you've not respected asset allocation and not respected strategy. You're only trying to sway towards return, and risk has no emphasis in your strategy. So if only 39% is there, you don't have to worry about hedging the 39. Point one. Point two, if you really want to hedge, first you have to understand what are you trying to hedge. If you're trying to hedge the currency movement, the action is different. If you want to hedge the market movement, then there are 2-3 alternatives. One is to buy long-term puts, which are available on NSE. That's one alternative which an NRI or a resident both have today. Long-term puts are called LEAPs. They are abbreviated as LEAPs, L-E-A-P-S. They are available in India from February 2008, if I'm not wrong. So that can be made available on the exchange by your advisor if you have one who understands it. The second alternative is to buy products which have insurance attribute, by which I mean the products which make money when the markets go down to create a hedge. So in Anand Rathi, we actually have a product which is called the Portfolio Insurance Product, which helps you protect against market falls. So these are the two most efficient methods. Of course, people hedge using short-term options, 1 month, 2 month options, but those are very expensive. You may finish your entire capital in insurance cost over 3-year periods.
All right, sounds good. A quick break now. We'll be right back. Feroze and Arun, do continue to stay on with us. And on the other side, we'll talk a little bit more about how NRIs can continue to invest in the Indian market. Stay tuned. We'll be right back. Welcome back. You're watching The Investing Edge, and with me, as always, is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management, and we also have Mr. Arun Narayan, who's been an investor now for over a decade. Mr. Narayan, let me start with you this time because, being an NRI investor, you've been investing in Indian equities. How do you manage your assets locally, and how do you build trust with an advisor who's many miles away?
Yeah, so first of all, I think compared to NRIs who live in the US, I think this is, for me, it's a lot better off because from Dubai to India is just a 3.5 hour flight. So it's not very far, and I've got a lot of relatives who are based out of India. So that way, it has not been very difficult for me personally. The other thing is most of my investments are financial in nature, so I don't have any real estate as such. So therefore, managing it, especially in today's world, is not very difficult. And my wealth advisor does shuttle between Dubai and India. So I get to meet him, at least once a month here in Dubai. And I'm in touch with him on phone and other things. So it's not been very difficult for me personally.
Okay, so you've had a good experience. Feroze, that question to you as well. How does it work from your side? How do you build trust with clients who may be very, very far away? And also, what's the kind of paperwork that's required? I mean, do they need bank accounts? What is the practicality, that they need to address to invest in India?
So it's very easy in today's times because of the connectivity digitally to even interact and act both. Of course, the setup of an account in India has a couple of layers of documentation, which I think is still doable, very easily doable. NRIs, I think, as a community, is a very sensible very long-termish kind of investors. Their expectations are reasonable. So I personally think from a wealth management outfit perspective, an NRI is a good segment to address. And I think it definitely is one space where Anand Rathi focuses. So point one. Point two is that documentation with respect to a single demat account or trading account setup could take a little more while, a 5-10 day extra turnaround time for an NRI. But NRIs also should be setting up Indian entities in the form of a simple private trust, which is what we end up recommending. Because NRIs have another layer of complexity in their life, which is assets in two different countries. So creating a good estate plan for an NRI is very critical. So once you create an Indian entity under the Trust Act of 1964, then you've created an Indian entity, and that's as good as any Indian resident. So that helps the NRI not just manage the money during his lifetime, but also try and have a smooth transition for assets which are not there in the same country which he lives in. So that becomes a very tricky one. Unless a wealth manager is ready to do a holistic kind of a plan for an NRI, it could be a little difficult if you have assets in different locations. Like Mr. Arun mentioned, that he does not have real estate in India, unlike several NRIs. But a lot of NRIs actually have real estate in India. That makes it very complex. So that's a third element where you do documentation, create an Indian entity, Indian vehicle, so that transmission of these assets also become very easy, because quite a few NRI have children studying abroad, like in the US or the UK, not just in the country which they live in.
Okay, Feroze, my last question now is not just NRIs, but investors as a whole. Because, since we started the Investing Edge, we have decidedly moved, from calling it the art of wealth management now to the science of wealth management, right? So therefore, from an investor's point of view, what is this ideal mix between algorithms or science and hard numbers and a human advisor?
So both have a place in wealth management. Point one is artificial intelligence, formulas, finance, discoveries which have happened, inventions which have happened over the years are very useful. At the same time, the human element of wealth management is very critical because during bad times especially, you will need hand-holding. You will need hand-holding as an investor to take you through the short-term volatilities, news, distraction, attacks from several marketing professionals who brilliantly tailor-make a product which looks very, very good but does not deliver the return. So I think a wealth manager or a human element with the capability to do analytical, science-backed wealth management, I think that's the sweet spot. Have both. Have a human wealth manager who can derive learnings from all the technology which is today available to test portfolios. For illustrative purposes, let me highlight that today a portfolio can be tested for the last 25 years of stress. It can be tested for the next 50 years before you embark on the journey. Like the model portfolio we follow, we try and test it using simulators which are available for the next 30 years to try and see the varied outcomes the same composition can actually throw up. And that helps the wealth manager make a choice of a portfolio which he or she can recommend to the client. So both are important. Human face to technology is what I think is the right combination.
All right, Feroze, Mr. Narayanan, thanks very much for joining in and for sharing your experience and insights with us. We'll wind down on the Investing Edge for this week. And as we do that, let me hand it over to Shweta Rajani, who's the head of the mutual funds segment at Anand Rathi Private Wealth Management, to share or rather decode a mutual fund scheme for us. Over to you, Shweta.
Thank you so much, Sumaira, for having me on the show. Today, we will talk about the Mirae Asset Emerging BlueChip Fund. It's an open-ended equity fund launched in 2010 as a mid-cap fund, but post-SEBI recategorization converted itself to become a large and mid-cap fund, which means that the fund needs to maintain a minimum 35% allocation to large caps and a minimum 35% allocation to mid caps. The fund is managed by Mr. Nilesh Surana since inception and co-managed by Mr. Ankit Jain since Jan 2019. Nilesh comes with a rich experience of over 20 years, and apart from being the fund manager, is also the CIO of the fund house. Nilesh is known for his blend style of investing, which means he has a well balance between growth-oriented companies and value-oriented companies in his portfolio. Talking about the portfolio is spread across 58 companies. In terms of market capitalization, it has around 58% exposure to large cap companies, 38% exposure to mid cap companies, and 4% allocation to small cap companies. The portfolio is fully deployed with cash levels being less than 1%. Talking about the evaluation parameters as per the Anand Rathi selection process, the fund is evaluated on 6 parameters of return consistency, risk, alpha consistency, return potential, valuation, and fund manager stock picking capability. Starting with returns, which is measured using rolling returns for the last 3 years, the fund has had the highest return in the category with a 3-year return of 3.5% as compared to the category average of a negative 2%. Similarly, talking about its alpha consistency, the fund by far has been the most consistent fund in the category, and its alpha volatility stands at, again, a 3% as compared to a benchmark or a category average volatility of 5%. Moving on to risk, the fund has very well managed its risk, and in terms of standard deviation, which is the risk measure, the standard deviation on a 3-year basis stands at 22.37, which is slightly below the benchmark volatility of 23%. Talking about valuations, here again, the blend style of the fund manager has ensured the fund has a lower PE ratio as well as a lower PEG ratio. Lastly, the fund manager, in terms of the stock picking capability, turns out to be among the top 3 in the entire universe of large and mid-cap funds. To give you value perspective, if you are an investor who had invested 1 lakh in the fund a year back, your 1 lakh could have grown to become 1,09,000. A same 1 lakh invested in the benchmark large mid 250 would have grown to become a 1,05,000. A 1 lakh invested in the fund at the inception would have grown to become 5,80,000 for you, as compared to the same 1 lakh invested in the benchmark would have grown to become a 2,60,000. To conclude, the fund turns out to be a star performer in each category and therefore a score of 5 on 5. So if you have the fund in your portfolio, please continue to hold on to it. Thank you.
Shweta, thanks very much for that. We'll wind down then on the Investing Edge. Thanks very much for watching. The news continues on CNBC TV 18.